everyone. How are you feeling this morning?
Ready for a new day.
Ready for a new day. Okay, great. So what we finished off yesterday with was me kind of throwing you into the deep end a little bit and giving you an exercise. Now, the exercise should have been quite straightforward for you, given what we did during the day, but there were a couple of things I threw in there that actually made it a little bit less than straightforward. One was this idea of calculating the cost of sales, and the other was just the idea of the format where you might have, for example, a little sub-column, and then you've got to add up the figures, and it's quite, it can be tricky to know where does the amount get put and so forth. So let's just briefly discuss what we did yesterday. So you were given this trial balance over here, and funnily enough, I actually think that when I do it again, I'm going to... No, that's all right. The trial balance is supposed to say as at. All right. So let me just... The trial balance always says as at because it's a snapshot of the values of your different assets, expenses, liabilities, capital, etc. at a particular point in time. But what's useful, because it says as at, you don't necessarily know for how many months that income and expenses is true yet. So I think next time I do it, I'm also going to just point out to you that this is the trial balance at the year end. So this is the 12 months, the financial year. It's holding that amount of income and expenses. Because remember, if it had just been 1 month so far, we would just have the sales and the expenses for 1 month. Then we'll have for the second, then we'll have for the third, then we'll have for the fourth, the fifth, etc., until we get to the end of the financial year. Once we get to the end of the financial year, those accounts actually go through a process of closing off, right? And the actual accounts get closed off and they sort of disappear. Where do they disappear to? Does anyone remember from yesterday?
Opening balances.
They disappear to opening balances, and the way that they disappear to opening balances in terms of income and expenditure is they're combined either into the owner's capital account in a sole trader, so that once a year when you actually finish off and start, it actually combines everything to do with owner's equity. Or in a company, it would be combined into your retained earnings account, so that you could then start your next financial year with nothing in your income and expense accounts and start measuring all over again. So it's almost like they're holding accounts during the year for the changes in equity during or due to profits. And we don't just want to take it straight to the equity accounts, because we want to be able to see at the end of the year, we want to be able to draw up an income statement, don't we, to be able to see exactly what was made in sales and expenses. So it was quite straightforward in that all you really had to do was take those nominal accounts, the ones with the short lifespan just for the year where you're keeping income and expenses, take them, put them in the income statement and establish the profit that would essentially be what you close off to the owner's equity. And then the remainder of the accounts you could then put into your balance sheet and ensure that your balance sheet balanced. Now, this is very much like question 2 of the assignment. In fact, it's almost identical. The only difference is in question 2 of the assignment, I have not given you the trial balance all nicely listed as debits and credits, okay? Which actually is not really necessary. As long as you know what goes into the income statement and balance sheet, you don't need to know whether it's a debit or credit. However, what if, let's say, for example, the debtors amount was missing from that trial balance? Would you be able to establish what it was?
Yeah.
Yes. If you have the rest of the trial balance, you could, because a trial balance should balance. Okay? So what you would do is you would simply list all your debit balances, list all your credit balances, and the difference between the two is the missing amount. So I'm giving you a little bit of a clue with relation to your assignment, that if in your assignment there is perhaps a missing figure, remember that if you do your trial balance as debits and credits, it should balance. And I'll just tell you as much as that, and I'm sure you can figure out the rest for yourself there. So what we did then was we transferred this to the income statement and to the balance sheet. So let's look at our model answer. Now, the first thing that was a little bit tricky was it was fairly straightforward to simply transfer your sales. That's what you sold. That's its selling price for the year. But what was a little bit more tricky was actually establishing cost of sales. Now, if you look at that trial balance that you were given opening stock plus purchases. You go back to the trial balance. That 41,100 is the inventory on hand opening stock figure for the year. This is the merchandise purchases as well as the delivery costs on those purchases. Now, basically, what you then get is if you take your opening stock, what you start the financial year with, and you add in what you buy, you are going to get your total stock held for the year. In other words, all the stock that at some point sat in your storeroom for that financial year. The problem is that I want on my income statement to know not what was bought, but what was consumed. And on my balance sheet, I want to know not what was opening stock, but what was closing stock. So what you had to do was effectively do a little adjustment, which we did directly, in fact, on the income statement. Usually this would be done in your books in order to get to the correct figures that you could put on your income statement. But I didn't want to go through all the hassle of showing you those entries in your books. We just did it directly on the income statement. And so what we basically did was we did a stock take, and we established from the stock take what the closing figure for stock was, and we gave you that figure there on the trial balance. And so what you needed to do was take off the unused portion from the total stock held. So this was the total stock held, and what you then did was tick off the closing stock, what was unused, and this now is the balance sheet figure that you want to use. Because essentially what you're doing here, remember, is you're taking what is normally a balance sheet amount, the inventory on hand, at the beginning of the financial period, and you're putting it onto the income statement as a cost, because you're saying by the end of the year that will actually have been sold and is part of my costs. Then you're adding your purchases on top of that, also as costs. But what you're then doing is you're saying, actually, you know what? This portion that is unused, I want to take this off the income statement and I actually want to put it onto the balance sheet as my new closing stock figure so that I can start the new financial year with the correct figure, so to speak, in stock. So essentially what gets taken off here in the income statement is only the difference between that and that, right? The amount that is consumed. Funnily enough, if you were to add this cost of sales to this closing stock figure, you would still get 653,200 because it's the same amount of stock you've held in total for the year, but it's not expressed as opening plus purchases. It's actually expressed as cost of sales consumption plus closing stock. That's how it's broken down now on the financial statements. Okay. All right, so now, once you had your sales less your cost of sales, you got your, what do we call that? Gross profit. And essentially your gross profit is your markup. It's simply the difference between what you buy the items for and what you sell them for. And when we're looking at the buying price of purchases, we always include the cost, the delivery cost of getting it into the business. If there is any delivery cost in terms of getting it out of the business, that is still an expense, but it's not considered to be part of the buying price. It's not the cost of securing the item, and it just goes under other expenses in the income statement. Okay. All right, what else? Okay, so then what we did was we said, okay, now that we have our gross profit or our GP, we want to add in any other income and take off any other expenses. So what we did was we took all the other expenses off that were not finance related, okay? So we left out the interest, but we took our marketing, our repairs, our salaries, our wages, and we listed those. And if you add those together, if you add the 16,890 to the 7,250 to the 92,000 to the 37,900, you get the total other expenses that you want to deduct, which is that amount of 154,040 Rand. And that's got to come off. Yes.
Do the numbers on the left not have to also be brackets? Should they negatives or should they be, is that reflects positives? I don't know.
For me, it doesn't actually matter, and you will often see on an income statement, they don't even necessarily put negatives in brackets, because if you know the format, you know that that's going to be minused. But to me, they don't necessarily need to be in minuses, because what you're actually doing is you're just adding those up. And then when you get to the total, that total is being minused. So that's why I do that. But if you wanted to put them all in minuses, that's perfectly fine. I would mark that correct. Okay? And if that works better for you, you're welcome to do that. Yeah. Okay. All right. Now, once you take off this amount here, you get an amount of 147,460. And that is what we call our operating profit. Okay. Your gross profit is your profit from just pure trading activity. In other words, what I buy it for versus what I sell it for. Your operating profit is from general operations, from your operations as a whole, including any other sources of income as well as any other operating expenses. Okay. Now, the interesting thing is after that, you can add non-operating income. And in fact, some income statements don't necessarily do this. If there's non-operating income, what they would do is after gross profit, they would just say other income, and they wouldn't really bother whether it's non-operating or operating, and they just list that, and then after that they take off other expenses, and they would actually still call it operating profit. I like this particular format because it raises the issue of what you spoke about, where let's say you're selling off your capital assets and you're actually making some profits from the sale of those assets. You would actually list this here in a separate section. So it would be nice to see what you're making from normal operations, and then on top of that you can see, oh, okay, this is, you know, additional income made from non-operating activities. So in this particular exercise, there wasn't any income from non-operating activities, but I thought it would be quite nice for you to see that that is a possibility to format your income statement that way. But it's also perfectly acceptable to actually have brought that up under gross profit. So you would have gross profit plus other income, and you would have put that there, and then less other expenses, and you would have I suppose it's not purely operating profit, then it would be best to actually say it's your net profit before interest, actually, so to speak. So there are different ways you can actually format your income statement.
And relating it to mine, it can be IFO, eh?
Yes,
From operation,
income from operations, absolutely. What you're really just trying to distinguish is the income you're making from your core business, essentially, versus other little sources that really don't have anything to do with your core business. Yeah. All right, then obviously what we want to do is we want to take off our interest expense, because we don't consider that to be an operating cost. It's not a cost of running your business, it's a cost of financing your business. It's called a financing cost. And so you would take off your interest expense and you get your net profit before tax. So please bear in mind that if you had simply taken all your income accounts, put them on one side like we first did yesterday, and then subtracted all your expense accounts, what you would essentially get is the same net profit figure. But you wouldn't see this nice little breakdown, actually, that this narrative format actually allows us. Right. Where you can sort of subgroup things, and you can almost see or analyze information in a more meaningful way. Now, if this was a CC or a company, you would then have a taxation expense. Why do you not have a taxation expense here? Because it's a sole trader. So he doesn't have to pay tax, or she doesn't have to pay tax. They do, yes. But it's personal tax. So what happens is that 1,004 Rand, 960, I never say amounts correctly, so I'll just say 104,960. That amount gets added to his or her personal income tax return, along with any other income that they've earned elsewhere. And then they pay tax on that according to the personal tax tables. And of course, I'm assuming that all of that income, all of those expenses are legitimately deductible, right? If they're not legitimately deductible, then obviously you would have to do some sort of adjustment to that profit figure before you declared it on your income tax return. However, what happens with a CC or a company is that the business itself is registered as a separate legal entity, separate from the owner. And so what that means is that it's the company who has to pay income tax and is responsible, and they pay at the company tax rate. What you would then have is your net profit for the year, and that net profit I wanted to also say, in CCs and companies, it's also possible to have a dividends declared amount, which is deducted from the final net profit for the period before transferring to the balance sheet. Yes?
I'm so sorry.
Yeah.
I think I maybe have missed this. But
Yeah.
the interest expense, is that all these expenses 40% of that? Or?
No, the interest expense is 42,500, and it's just taken directly from the trial balance. Yeah. No, that was because you unfortunately weren't here, so it makes perfect sense that you need to ask questions. Once we have that profit figure, if this was a company or a CC, that profit figure is not necessarily what is added to the balance sheet, because you may decide to draw against those profits and declare dividends. And so what you could then actually do is have an additional expense, which usually, funny enough, is not shown directly on the income statement. It's actually usually shown in something called the Statement of Changes in Owner's Equity, which almost acts as a bridge between the income statement and between the balance sheet. Because the Statement of Changes in Equity in a company or a CC would show you what was your share capital at the beginning of the year, did you issue any more shares, what was the profit made for the year after tax, but out of that, what was the dividend that was declared that was actually not taken to equity, etc., etc., etc. But just bear that in mind. Remember that in a sole trade or a partnership, it's still possible to draw profits, but you won't actually show that in any way on the income statement, because what you will do is you'll take your full profit through to the balance sheet. But remember, your capital account, as the owner has drawn, there will be drawings. Does that make sense? So if he's drawn any profits, that will be sitting in the drawings account. So what you would then have is all his capital contributions plus the full profits for the year, and any drawings, whether it was against capital or profits, will have been allocated to drawings during the year, and then that will come off that full total, so to speak. Whereas that's not quite what happens in a company. In a company, obviously no drawings are allowed. So what will happen is you will take the profit through to the retained earnings amount, but what you will then do is take off dividends that you declare, you'll take off those dividends and you'll actually allocate them instead to something called a dividends payable account, which is treated as a current liability. Yeah.
So,
Yes?
what comes after the other income, after non-operating income? You're saying it will not only be the interest and receipt, it can also include
Perhaps profit on the sale of the asset or something like that. It could even, if you feel that that's not part of your normal operations, you could even put it there. So let's, for example, say you've got a small unused section of your building and you decide just to rent it out so that it's not going to waste. You could also put some rent received there. If you feel it's not part of your core operations, business operations, you could put it there so that you can see what you make from your core business operations versus not.
So how do you treat the difference in tax paid vis-a-vis what is actually supposed to be paid?
What do you mean? I'm not quite sure. So you're saying, let's say the profit figure is slightly different from what you must pay tax on.
Yeah, let me say there is a certain amount of tax that you have paid already during the course of the year.
Oh, okay, all right. That's a good question. What you do when you create that taxation account, all right, is it's actually, once again, it's that idea of double entry. So on the one hand, you have your tax expense account, okay, which maybe for that year you decide is or you calculate is 20,000. That's the full tax owing on that. Now, what you would then do is you would say that that is owing to the receiver of revenue, what we call tax payable. So what you're doing is you're essentially saying, I'm financing this particular expense with a bit of a loan on credit, so to speak, yet, because you haven't paid it over to the receiver of revenue. This is your expense account that goes on the income statement. This is your loan. But if during the year you had already made perhaps provisional tax payments, that kind of thing, what you would have done is you would have almost created that prepayment in this taxation payable account. Does that make sense? So let's say during the year there was a payment of 5,000. That would have come out of the bank account, and what you would do is you would take it to the taxation payable account so that your liability account could actually sit with almost like it's like an asset. It's like a prepayment at this point that I'm going to use whenever I log the full asset, so to speak. And so once you put through this entry, what you end up with in the taxation payable is just the amount that is specifically payable, whereas what you end up on the income statement is the full cost that is owing. And when you make any further payments against this, it comes through bank and the taxation payable account, and not through taxation again, if that makes sense. So what you'll find is on your income statement, you will always have the full tax cost for the year. What you will have on the balance sheet is only the amount that is outstanding to the receiver of revenue. Okay. That's the liabilities. Sorry? Either outstanding or prepaid. So it's quite possible, yes, that if you for some reason had overpaid, so maybe you had paid 25,000, you would actually be sitting with this having a debit balance of 5,000, which means the receiver owes you 5,000. Right? In which case, unusually, this particular liability is actually acting like an asset. You treat it like a current asset, in fact. It would be like a prepaid expense. We're going to talk about prepaid expenses now. Okay. Because remember, when something has a credit balance, we know that it must be a liability, capital, or income account. All right? If it has a debit balance, it's actually an asset or an expense. That 5,000 is actually a debit. It's not an expense. It's a prepayment. It's actually an asset. Right. Yeah.
What is this deferred tax?
Sorry?
Deferred tax, where do you locate it?
Okay, deferred tax is actually quite, it's quite complicated. And to be honest with you, it's now been 2 years since I did a deferred tax calculation, so I'm not even sure that I would necessarily be giving you the correct information. Can I just check one or two things and answer that question after break? Okay, because I want to be sure that I answer it correctly. Okay, all right. So now what we would do is we would take that amount, the 104,960, and we would transfer it to the balance sheet. So under equity, you can see capital plus net profit. And then all we had to do was transfer the remaining balances through to the balance sheet, what was left over of the trial balance. There were a couple of tricky ones. So under the non-current assets, both that furniture and fittings and motor vehicles, what you actually did was you transferred not the cost, but the cost less accumulated depreciation. So there was a little calculation that we did over here where we said furniture and fittings at cost is 54,600 less the accumulated depreciation equals the carrying value on the balance sheet. And if you go to the balance sheet, it's at its carrying value. So remember what we did yesterday when we did the accounting equation exercise was I just actually took that 583 Rand directly off the asset account. But I said in practice you don't want to actually do that. You want to keep the cost in the cost account, and all reductions, all credits over the years to that account you want to log to something called the accumulated depreciation account so that you can always see the cost. Now, funnily enough, there was a bit of a mistake in this exercise. Did anyone notice it?
Yeah.
What was it? I don't know if it's a... Yeah. I keep on forgetting to change it. If you take that accumulated depreciation of 10,200 and you add 24,800, what do you get? 35,000. Okay. If you go back to the depreciation cost for the year, what is the depreciation cost? 7,900. So the depreciation cost is higher than the accumulated depreciation. Is that possible? No. All right. So this raises an interesting point. A, it's that your lecturer was not quite thinking when she set up the exercise. And B, that in fact just because a trial balance balances is no guarantee that it is correct. All it is a guarantee that you have applied the rules of debit and credit. It's just a partial check. If your trial balance doesn't balance, you know for sure that it's wrong. But if it does balance, that's not necessarily a guarantee that everything is correct. You still need to perform all other checks. That's why you hear accountants talking about, I've got to do the reconciliations, I've got to check the ratios, etc., because it's quite possible, as long as you do something wrong on both the debit and the credit side, you'll still balance. Okay. Or if you leave something out completely, you leave it out on the debit and on the credit side, it's still going to balance. Okay. Strictly speaking, that whenever you actually look at a trial balance, your accumulated depreciation at the very least should be equal to your depreciation. If it's your first year of trading and you've never written off depreciation before, then accumulated depreciation can at least be equal to accumulated depreciation. But in subsequent years, your depreciation figure on your on your income statement, should actually always be smaller than the balance sheet figure, because the income statement figure is the cost for just that year, whereas the balance sheet figure is the cost that's built over all the years. Okay. So it's really, you should never have accumulated depreciation being less than depreciation. It should either be equal or more. Okay. Right, I just listed there that if you had intangible assets and investments, that's where you would put them in the balance sheet. You then add off all of the non-current assets, the land, the furniture, the vehicles figure, and you get the total non-current assets of 490,600. Then under current assets, look, we've got our inventory on hand, but that inventory figure is the closing stock figure. We've got our debtors, which is our outstanding debtors. A fancy term nowadays is accounts receivable. It's become very popular, been used for a couple of years already. And then we have our cash and cash equivalents. Now for our cash and cash equivalents, what we basically did was we added our bank figure to our petty cash figure, and that gave us total cash and cash equivalents. Okay. Now, funnily enough, when we calculated the cost of sales, that's really something called the periodic system at work. There's also an inventory system which is called the perpetual system, which we're not really going to talk about, because at the end of the day, both systems end up with cost of sales, what you've consumed on the income statement, and inventory on hand, what you have on hand in the balance sheet. But with the periodic system, what you're actually doing is you're only periodically calculating what's cost of sales and what's closing stock. Right, so you started the year at the beginning of the year with opening stock. You just basically left that as your sort of almost average stock holding. If you carry it through your whole year, and as you purchased, you added it to the purchaser's account, and only at the end of the period did you correctly break that up after a stock take into the closing portion and the cost of sales. In the perpetual system, perpetual means to do something all the time. I always say if your spouse is a perpetual nagger, then he or she is a dedicated nagger. They do it. They keep you on track all the time. Whereas if they're periodic, they just do it every now and again. Every now and again, there's a correction. That was our every now and again correction that we did for stock. But in a perpetual system, what you do is as you buy the stock, it gets written off to the inventory account, or well, not so much written off, but allocated to the inventory account as an asset. Let's say we used the 5 and 7 yesterday, that example. I bought this for 5. I take it to an inventory account for 5 Rand. And then when you actually sell it, you record both the sale of 7 Rand and the fact that the 5 Rand is coming out of inventory and going to cost of sales. All right. So you're automatically updating your inventory as you make, not just as it comes in, but also as it goes out. In that particular case, your inventory account will always show the correct closing balance, and your cost of sales account will already have been calculated for you in your trial balance when you use the perpetual system. And the perpetual system is quite nice because what that means is if I do a physical stock take and what's on store or in stock is not what it should be according to the accounting records, I know that there's been theft or spoilage, there's some sort of deficit going on, right? Whereas with the periodic system, that becomes more difficult to actually calculate. But at the end of the day, regardless of the inventory system, you end up with the same thing. That what you want on your income statement is the stock that was consumed, and what you want on your balance sheet is the stock that is on hand. Now, yes?
Is it not, bringing about some challenge on determination of your markup? Because your markup is always based on the stock, cost of stock.
Yes.
And my understanding of the perpetual system is that every time you have the new stock,
yes,
it will affect the average cost.
Yes.
Of
yes.
the stock.
Yes.
Then obviously affecting the
yes. It can.
markup as well.
It can. Yes. Yeah. So yes, depending on, it also depends on whether you use LIFO and FIFO and that kind of thing, but apparently also whether it's perpetual or periodic, you'll get slightly different results actually. So yes, that is a reality. But hopefully the difference will not be sort of too much to be material, but yes, it is a possibility. Another thing that I wanted to point out here in terms of inventories on hand is that inventory is valued at the lower of cost or net realizable value. You'll always see that. So net realizable value means what can I sell it for, essentially. So, or to simplify it, it means what can I sell it for. Now, what that means is mostly the cost is going to be lower than the selling price. Do you agree? So most of the time we value stock at its cost to the business. However, if for some strange reason the cost for the expected selling price falls below the cost, you actually have to anticipate that loss and write it off in this period. So let's give you an example. Let's say that your stock is valued at 15,000. That's what it cost you. And you expect that you're going to sell it for 30,000. Well, then there's no problem. You're going to sell it for more than its cost, so you're going to value it at 15,000 in your books. Okay. But let's say that there's some sort of market crash, right? And there's no longer a market for this product. Or you go and you look at the stock and it's actually been sitting around for a while, it's a little bit old, you're going to have to sell it at a discounted price. Or perhaps you can't even sell it, okay? But anyway, let's say we've done that kind of evaluation for the stock and we've discovered that this stock of 15,000, in all likelihood, we haven't sold it yet, but we think it's probably only going to go for 10,000. You have to write off a provision, you're quite correct. In fact, it's not even a provision, it just gets written off, so to speak. But I understand, yeah, it is overall the idea of a provision, because usually in accounting we use something called the matching concept, which means I record income in a particular time period, and that time period is when it was earned. And I only want to know the costs. I expect to match the costs to that earnings, so to speak. So if you used the matching concept and you haven't sold that stock yet, strictly speaking, you should say, well, I shouldn't write it off in this year. I should wait until next year when I sell it at the reduced price and then absorb the loss then, according to the matching concept. But sometimes other concepts take precedence. Basically, the prudence concept says, if you have a strong suspicion that you are going to make some sort of loss or something nasty is going to happen, that's where many of your provisions come in from the prudence concept, is provide for it now rather than have a nasty a shock in the future. Right? So rather absorb it in this financial period. The prudence concept says be prudent, be conservative. Don't overestimate your assets and expenses, your assets and income, which is the good things, or underestimate your expenses and your liabilities, which can be the problematic things. So what you would do in that case is your stock is sitting in your book at 15,000 Rand. Right? What you would need to do is you would need to reduce its value to 10. So So you would need to take off an additional 5. In fact, if we go back here, if I did a stock take and I discovered that that's what the stock is valued at its cost, but in fact, maybe it's only really worth 40,000. We think we can only sell it for 40,000. What you should only take off here is 40,000. The difference needs to be absorbed into the cost of sales for the year. Okay. In the past, it used to be absorbed specifically into something called an inventory deficit account, and it was kept separate from the normal cost of sales for the year. But with the changes to IFRS nowadays, we actually just absorb it into the cost of sales account. So in that example where I had 15,000 in stock, I would need to take an additional 5,000 off stock and add an additional 5,000 to cost of sales for the year. Okay. Stock is valued at the lower of cost or net realizable value. Then you can basically write it back, and the way that you'll write it back is you won't even necessarily write it back. It just means that you'll absorb a greater profit in the next year. Because when you actually write off that stock next year to cost of sales, you're writing it off at 10,000. So you're writing it off at a lower cost than you probably would have, than you definitely would have had you not done the provision, which means you'll absorb a greater profit that year if you compare your cost of sales to sales. Yeah. So hopefully if you can get rid of all of that stock, then you can have huge profits in the next period.
It's so fun to do that.
I know, it is not fun to do that.
Rules also look at you odd if you write back huge profits.
Yes.
You make huge losses the year before. So
Yeah.
you've got to be careful with that.
Yeah, it is a, yeah. Okay, so if I look at equity, that was straightforward. I simply took the owner's capital, subtracted net profit. Now, interestingly enough, because this is year end, that net profit will actually be combined into the owner's capital account. So what will we start the next financial year with as the balance for capital? 319,500. Yes. Okay. And now there'll be nothing in income and expenses next financial year. I'll start all over again from scratch, from the start. And then at the end of the financial year, I'll have that 319,500 plus perhaps any additional capital contributions I've added during the year, and less obviously any drawings during the year. And then to that, I will add the profit calculated for that year and then start the year again. I've got some non-current liabilities and I've also got some current liabilities. I just put the bank overdraft there so that you would know if there was a bank overdraft, that's where you would put it. Okay. Now, what's great about this is that, can anybody tell me why they think those assets have been divided into non-current and current assets? Sorry? No.
I was thinking out loud.
Oh, okay.
To differentiate our long-term and short-term.
Yes, absolutely. Well done. Okay, and also you will notice that there's a reason that non-current assets is listed before current assets. Does anybody know why? Just kind of almost related to your answer. You've pretty much answered it.
The long-term will remain the same over the months and years.
Yeah.
And your current assets will change.
Yeah. Absolutely. And also, with your long-term assets, they're staying in the business for a long time. So they're part of the almost permanent structure of the business. Whereas the current assets, as you say, are part of, I like that idea of a cash merry-go-round. It's called working capital. You ever heard that term, working capital? If you ever wanted to know what it means, it's basically current liabilities and current assets. It's that cash merry-go-round where you actually get capital from your creditors, your bank overdraft, you turn that into stock, you then sell that to debtors, you collect that cash, you use that cash to pay your creditors, but in the meantime, you've bought more stock, so you're keeping that cash merry-go-round constantly moving. Whereas those other assets are more part of the permanent structure of the business itself. Another way of looking at it is that you are pretty much listing it in reverse order of liquidity. So if you look at current assets are more liquid than non-current assets. But even within the current assets, what's your most liquid asset? Cash and cash equivalents. So what's right at the bottom in reverse order of liquidity? from most liquid to least liquid. So cash and cash equivalents. Okay, all right, what's your next most liquid asset? Debtors, because at least you've made the sale. All you've got to do is collect the cash. What's your next? It's inventory. Inventory is less sure as a source of cash because A, you've got to do two steps. You've got to sell, you've got to find a buyer for that stock, and you may still need to collect that money and wait to collect that money. Same thing with the non-current assets. If you in your non-current assets needed cash, probably you would want to first go to your financial investments rather than look at your property, plant and equipment, because once you started to sell off your property, plant and equipment, you start to affect your sort of ability to operate. So usually we always put the financial investments underneath the property, plant and equipment. So it's a kind of reverse order of liquidity. There's also a logic here in equity and liabilities. Does anybody know what that is? They are in a kind of reverse in terms of the length that those funds will remain in the business. So if you look at current liabilities, in the near future, you're going to have to pay those off pretty soon. Those are not really a long-term source of funds. Those are really just short-term funds that will need to be paid off pretty quickly. The non-current liabilities, particularly if you do what I suggested, which was, let's say you've got a mortgage bond, you actually break it up into the long-term and the short-term portion. In other words, what you're going to pay in the next year versus what's going to take longer than a year to pay off. Those long-term liabilities, yes, do need to be paid. So they're not going to be in the business forever. They do need to be repaid. But we know that they don't need to be repaid within the next 12 months. So they're a fairly stable source of funds remaining in the business, so to speak. And owner's equity, of course, is your most, because really, you don't have to pay out the owner, all right? Those funds can remain in the business forever, or indefinitely, basically, all right? Unless, of course, there is something called preference shares. I don't know if you know about preference shares. Okay. When you sell shares in a company, you can buy ordinary shares or you can buy preference shares. And in fact, preference shares can have quite a bit in common, not so much with liabilities, in that there's a guaranteed dividend and sometimes there's a buyback period and that kind of thing. And in fact, some preference shares can even appear on the balance sheet under liabilities because they act more like those than equity. But most preference shares actually just are also included under equity in the balance sheet. Okay. All right. So tell me, guys, who's the biggest contributor of funds to this business? No. It's the bank. It's 323,300. Okay. Biggest contributor is the bank. But the owner follows pretty close behind that. Okay. In terms of the equity of 319,500.